Hello, everyone. Welcome to the weekly roundup. Today, we would cover interest rates, inflation, and market sentiments. Hello, Ben.
Hi Eva, how are you?
Good. Great views. I think I see Parliament.
You can, if it's not too bright, it's right here.
Nice. So we're going to start with, I think, one of the interesting news during the week. There are talks underway to replace Powell before his term ends. I mean, what does it say about Fed's independence and how would markets react to a more dovish chair taking over?
Yeah, it seems to be getting traction. And look, most things that Trump has done, at least in the time he's been president, is he try to float things out there, try to see if he can get enough people on his side to take action. His view is he wants rates lower. So that's why he's attacking Powell. He's saying that Powell's spending too much money on the renovation at the Fed or fraudulent activities or, anything he can, I guess, to float out these concerns around why Powell should no longer be in the chair. I mean, as for what it means, the general prevailing thinking is that it destabilizes the market and the economy. And your point about the independence of the Fed, honestly, look, the Fed's not independent. Neither is any central bank in the world. They're all connected to some extent. So uh, ultimately, I think they're going to have to find a reason to fire him if they want to get him out before May. I'd be shocked if he can last this long. When Trump came to the defense of him yesterday afternoon, it's because the markets were correcting. So the initial knee-jerk reaction is, holy smokes, what do we do? Yields went higher, which again is ironic, but yields went higher and US dollar went down. So US dollar going down makes sense because Trump's talking about having lower rates. So I'm not exactly sure why yields were going higher because whoever replaces Chair Powell will be more dovish to your point. He'll be or she'll be someone that decides to cut rates sooner rather than later. So that should be stimulative and that should bring the yields down. So lots to pay attention to there and quite conflicting around what's happening.
Okay, speaking on yields, the US 20 and 30-year bond yields, they've crossed into the 5% range. What are the implications for, the regular guys, so mortgage rates, consumer spending, leveraging? What should we be looking out for? What is happening now?
Yeah, so where the US is different than Canada, that's why it's very important because US, when you buy a house there and you get a mortgage, you lock in on that 30 year. It's the 30-year bond rate plus 2 or 3%. So we're somewhere between 7 and 8% on mortgage rates right now, which is quite high. And the housing market's already slowed in the US. And so if we're staying at these elevated levels, there's the view that things will slow down. And US individuals have always used their houses as part of their consumption goals. So, if your house price isn't rising anymore, your credit availability is shrinking, and then you spend less. So it is a very important level from a what's the impact to the everyday consumer. I also think it's important level for asset allocators, the big money investors, the big pensions, the big endowments, the sovereign wealth funds of the world. I think they would look at it and say, okay, we've made X 100% on these individual stocks, and we want to have some security and safety to meet our pension needs and objectives and such. And they can lock in at 5%. Yeah, I think that it starts to get a little bit more attention to the big asset allocators. So I think that the 5% level is quite relevant. Um, and one that is super under pressure right now. And so if you get some kind of a mean reversion with yields and with US dollar, because US dollar DXY, like the index, is down about 10% this year. So if you get a possible recovery in the US dollar and yields falling, I do think it's that beach ball underwater where you could get a pretty big move in the long end if you own the bonds. So I had a number of conversations with clients the last couple of weeks, and they said, "What's cheap?" And I'd say that's pretty much the only thing. 30-year US bonds and US dollars is the cheapest thing out there.
Okay, going back to inflation, this seems to be creeping up a bit, CPI nearing 3%. Is the Fed's cautious stance still justified?
So I think it depends what they are worried about right now. And so I think the answer is inflation wise, yes. But I think from a big picture wise, probably not. And so when the Bank of Canada started cutting rates a year and change ago, it was the view that, inflation's still running a little bit hotter than we'd like, but the economy's slowing, unemployment's rising. We're going to try to get ahead of the curve. And so I think the Bank of Canada did quite a good job of doing that. And so we'll see if they continue on that path. And so the Canadian economy's done okay and it's relatively stable as a result. Where the US, I think they're so uber focused on inflation that they're losing track of the other things. And that is many of the things we talked about here, which is the consumer stretched. You get consumer debt levels at all-time high, you get unemployment rising, and you got the economy slowing. And so the Fed, I think, should probably be worried about that and be considering doing something with rates, but they're laser focused on that inflation number. And so until Powell gets replaced, I think they'll probably stay focused on that number.
So we saw more earnings releases this past week. Anything worth noting, and how has market been reacting to the numbers?
Yeah, so I'd say all over the place, and there's a lot of beats, and typically, right when you get a beat in financials, like J.P. Morgan had a beat, and then Citi came out with weaker, and Bank of America with weaker, and so I'd say it's a bit more all over the place than typical. Coming into this S&P earnings cycle, though, expectations were quite low. So I would have expected a little bit easier beats in a lot of cases. Um, One of the companies we own, though, that I sold today, which is Pagaya Technologies. So Pagaya is something that we started buying 2.5 years ago. But their earnings came through great and the stock popped 20% and, clients are up about 98% on it. But so there are some beats that are coming through this way. But generally it's been much more company specific and not industry specific, which is a little bit different than other earning seasons I've seen.
Let's see the charts.
All set?
Yep.
All right, perfect. Okay, we're July 17th to just around 1 o'clock. We're recording. So anything that happens after this, we'll comment on next week. And let's start with this. And lots of questions continue around mortgages, mortgage rates. Certainly, if we look at what's going on in the world and markets, and if you follow Canadian real estate to any degree, you'll see that the Toronto condo market is in a bit of turmoil right now. A number of the developers are coming under pressure. And part of that is directly related to this because we're coming into the end of the COVID cycle, we'll say. So in the summer of 2020, if you zoom backwards, rates got cut down to zero. So overnight rates were effectively zero. I think we were 0.25, but effectively zero. And you could lock in 5-year mortgages at, depending on the time you lock in, somewhere around 1.5 to 2% for 5 years. And so now we're starting to see all of that roll off and come due. And so you're seeing an interesting setup where people are starting to say, what do we do? They're obviously rolling over at higher levels. You can go with the variable rate, which you can see some of that. But in the case of this chart here, you'll see a big chunk of them, particularly in the second half of 2020, were in 5-year fixed. So if you're at 2%, You're locking in 5-year fix now at I don't know, somewhere closer to 5 or 6%, depending on where and how you roll it, what your credit levels are like and such. But we're into a period now where things are rolling over at higher rates. And to my point, just around the Bank of Canada, they're very aware of this. And part of why they started to cut last year is with the view that this was coming down the line, and it's starting to have an impact today. And so just with this comment, a few more on mortgages. And so you're starting to see current rates. Here you go. This is a great picture of it visually to see where rates are there versus where they are today. And so if you go on the variable rate, which people are starting to do that now, is a little bit more variable with the view that rates continue to come down. And we think that's the case. We're still in the camp where we see 75 basis points of cuts this year or 3 more cuts. But there is no doubt that the reset is resulting in tighter financial conditions for consumers and for the individuals, and that's not great. That's not what we want for a healthy economy. This as well is job growth. So this is another thing that's very important for what's going on with the Canadian economy. And so this chart from our team says job growth almost certainly weaker than the Bank of Canada thinks. And so, my point of praising them last year with getting ahead of it is a little bit on the other side here, where it looks like the job growth or the lack of job growth or job losses is starting to pick up a little bit faster than the bank's anticipating. And so, where consensus would be 50 basis point lower this year, we think 75. So we're in the camp that we think there's some surprises to the employment data in the last half of this year. And so we'd be watching those levels quite closely to see what happens and what level we get to, but certainly heading in the wrong direction right now from what's to happen with Canada. As we do, Eva, we go back often and look at decisions, and sometimes you're happy with them and sometimes less so happy with them. Obviously, I referenced Pagaya, and that was an interesting story, something that it bought immediately, didn't work out right away, added to the position twice, and then resulted in a good outcome for clients. This was another one where in the middle of April, where we started to see a pretty material correction into Liberation Day. We owned yen for a lot of clients. So FXY is the ETF that is a yen proxy, and yen went up into that environment as a safety valve. Often currencies with the yen and the US dollar tend to be quite positive into a market correction. So yen was rallying. And there was another area of the world, the markets I liked, which was metals. And so XME is base metals. And so XME was down pretty significantly. And so we took the opportunity to sell yen and buy XME. And from that April 4th, from that transaction to the where we were a couple of days ago, was looking at close to a 40% delta. So a 40% outperformance by making that decision to adjust in April to reposition based on the likelihood of where markets went from there. So we have not exited the position yet in XME, but certainly this has been a good trade and a reminder around why you have to currently be cautious and pay attention to what's going on and make active decisions when opportunities get presented. And finally, the opinions expressed do not necessarily reflect those of National Bank Financial. If you have any questions, certainly consult myself or your advisor, and they're happy to talk to you in more detail. And everybody's risk level and tolerance is different. So please certainly take the time to understand what is right for you. There we go.
Thank you, Ben. Great positions.
Yes, absolutely.
So what are we looking at for next week?
So we are still about a week and a half or 10 days or 13 days away from the rate announcements in the US. So we have both Canada and the Bank of Canada on the 30th of July. So we'll be watching that, watching the inflation data, employment, continue to watch earnings. As I say, that it's been much more company specific this time. So as valuations continue to get stretched, as I noted in one of the dailies, S&P is close to 22 times earnings again. So we start to get up at these levels. I'm looking for what can I sell that's done quite well and buy something that hasn't done as well? And so I'd be scouring the market looking for that. And so that's one of the things I've been doing is where are there opportunities that haven't been taken advantage of yet? So looking for sells and what to buy. Easier to know what to sell because lots of things have gone up. Harder side is where are the opportunities to buy something and spending quite a bit of time on that right now.
Okay, great. Thank you. Thank you for listening, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of the video and in your email box. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you once again for listening and have a good weekend ahead.
Thanks,
Bye.
everybody. Bye.